Markets are collapsing and there's so much noise and discussion flowing throughout the space. But you might be wondering, what's the reality? Where do things currently sit? And what is this bear market that everybody keeps discussing? Well, today we're going to peel back all of the noise. We're going to dive into the numbers, the data, and the facts surrounding what is a bear market. And ultimately, what does this mean moving forward as the markets have officially entered into bear market territory, with some indices officially entering into a market crash?
Welcome to the channel and enjoy.
So we're going to get to the bottom of it all, and we're going to peel back all of the numbers and dive into the data to get this understanding about where we're currently positioned. But before we do, we should take that step back and have a think about the current lay of the land. As we know, the era of easy monetary policy is over. We're entering into a tightening cycle, and this is reverberating around the world. The last couple of years, we've had the everything rally, but really over these past few months, particularly the start to 2022, it's been a very risk-off tone throughout markets. The S&P 500 has been down 10 of the past 11 weeks. It's now into bear market territory, down by over 23%. The NASDAQ has entered into market crash territory, down by over 32%. This is the second time since March 2020 where we've entered into these levels. And for a context of just how bad things is and the limited breadth in terms of strength, according to Bloomberg, over the past 5 sessions to Thursday, less than 10 of the entire S&P 500 were above their 10-day moving average. Gives you a bit of an understanding about just how dire things have been. As we know, the cryptocurrency markets have crashed as well. S&P 500 into bear, NASDAQ into crash territory. The markets are in disarray, and there's a significant amount of uncertainty about where do things head from here. And so with that leads us to a bear market. What is a bear market? What does it all mean in terms of the context of the current state of play? So a bear market is defined as a sustained period where the equity markets are down by over negative 20%. This is contrasted by a correction, which is negative 10%, and a crash, which is negative 30%. So that's the hierarchy of downfalls. In terms of bear market stats, no two bear markets are the same. I'm sure that goes without saying, but there's been 14 bear markets since World War II. This averages out to about 1 every 5.4 years. These bear markets have ranged from as short as 1 month, which we saw in March 2020, out to multiple years as well, extended periods. It's worth noting that of these 14 bear markets post-World War II, 8 of those have preceded recessions, while 6 have not. So it's not a perfect correlation. Bear market doesn't instantly equal recession. Bear markets, however, were more frequent prior to World War II, with 12 bear markets in the period between 1928 and 1945. According to Hartford Funds dataset, the average length of a bear market is 289 days, or about 9.6 months. That's significantly shorter, however, when contrasted with the average length of a bull market, which is 991 days or 2.7 years, with the average frequency of bear markets every 3.6 years on their dataset. If we were to end this bear market on the 289-day mark, just for a contextual point, that would end in around mid-October 2022. According to another dataset from Bespoke Data, once the S&P 500 hits the 20% bear market threshold with the drawdown, the market typically falls another 12%, and it takes an average of 95 days to hit the end of the bear market from that point. Now, in more than half of the 14 bear markets since 1945, the S&P 500 hit a low point within 2 months of initially falling below that 20% threshold, and forward returns from that point were largely positive. Bespoke points out that with the index rising an average of 7% and nearly 18% respectively over 6 and 12-month periods following that. But going back to that recession stat, as we talked about earlier, not all bear markets precede a recession, but if the economy can avoid falling into a recession, the bear markets are generally shorter, with 449 days with a recession, however only 198-day bear market on average if the recession is avoided. And so with all of those stats and numbers, you might be wondering what happens from here. First and foremost, if you haven't yet, we've just dropped the second channel. It's live. It's called For Investors. You can check it out. Go subscribe and turn your bell notifications on. But what happens from here? A lot of investors and analysts are looking for a washout or signs of capitulation, that real blow-off, bottom sell-off. We haven't yet seen that, though the breadth and the velocity and volume of sell-offs have been increasing. Ultimately, nobody knows how this will end. Of course, everybody has their own assumptions, perspectives, and understandings, but everyone's looking at the same sets of data and coming to different conclusions. We're currently trading at just around above a 15 times forward PE on the S&P 500. We saw the 2018 bear market at the back end of 2018 and then the 2020 pandemic crash end with a 13.5 and a 13x multiple on forward earnings. So that gives you a bit of a context. And if we were to reach, say, that 13.5x multiple, that would take the S&P to the 3200 level. Just for that interesting understanding. There's obviously a lot of unresolved questions. Supply side inflation, how will that fade? Will it start to moderate towards the back end of the year? Of course, on the demand side, we're going through a hiking cycle. What will happen as rates continue to raise up? And how will the demand side play out? And obviously, can we avoid that recession and that hard landing? The strength of the consumer as well. Will it stay resolute? And how are earnings going to hold up? We're not far off this upcoming earnings season. We know there's been rising input prices. We know there's been labor shortages. How's that going to feed into earnings and ultimately profitability? The housing market is another question, especially with the rising rates and the mortgage repayments. And ultimately, what happens to growth and the labor market? There's a lot of questions as we see if we can avoid this recession and this soft landing. It's worth noting as well when you're thinking about the space that the stock market is not the economy and the economy is not the stock market. Obviously, they're correlated, but they're not moving in tandem and they move independently of each other. So it's worth noting that there are to delineate that when you're considering this. The markets go up, they go down, they move in cycles. It's a natural part of functioning markets. If you're assuming you've got a 50-year investment horizon, it's likely you can expect over 10 bear markets in that time, and potentially up to 5 crashes, assuming one every decade. And so there's no way to avoid bear markets. They're going to happen again in the future, and we will see more in our time. Bear markets, however, can present opportunities, of course. Volatility can present that opportunity. But the question of where and when those opportunities are primed is what makes a market. There's always contrasting views, and I'd love to know yours. So drop in a comment below. A big thank you for joining us. For now, stay well and happy investing.